accounting, including the business strategy. I also work as a full-time CFO with a hotel company and taking care of their operations. So Wipro is my, you can say, is my side task that I am side passion that I am doing, and I'm also providing online learning courses and webinars as we are here now. You are watching it in my CPE. So today we are going to talk about the financial analysis. How can we understand operational challenges with the help of financial statements analysis? Usually, financial statement analysis is done only many of the cases only at the end of the year to find out what is the profitability and what how much tax do we need to really pay. But the financial numbers, the profit and loss account, if treated very well, if looked at in details, can really help to understand if there's any operational challenges, if we need how we need to improve the operational, is it our sales and marketing efforts or business development efforts are paying off what they're supposed to do, and how we plan them. So there are many ways where how we can analyze these facts. So in this webinar today, we are going to talk about those steps and how we do the financial analysis and how we can understand these operational challenges. So let's go ahead and learn them. So before we discuss the purpose of the financial statement analysis, let's understand quickly what are the users, who are the users, and why the financial analysis is required. So financial statements are useful for multiple stakeholders, whether they are internal users, maybe managers, officers, internal auditors, government employees, and then there are many external users, shareholders, lender, customers, taxpayer, tax collection departments, compliance department. So they all need to understand financial statements so that they can make different decisions. So everybody has different purpose to understand the financial statements. Managers and officers may want to understand whether their strategies are working, whether they are able to achieve the profitability they are tasked with. Maybe their incentives are tied up with the profitability of their department or with the overall company or with the shares of the share prices of the company. Internal auditors would want to see if there are any trends or there are any signs or red flags related with the lapses of internal control. Are there anything related with the overall performance of the company which should be worried from the purpose of proprietary controls? External users, shareholders would like to know whether their money is getting the return that they're supposed to get, or they should make a switch. They may want to analyze the financial statements in order to understand whether they should invest into the companies or not. Lenders may want to understand whether they should give loan to the company, whether they will be able to repay the loan, whether they will be able to pay the principal and the interest on time. Customers would want to know whether the company will be able to agree or will be able to complete their commitments. If they are the major suppliers of the company, suppliers would want to know whether they can the company can pay. So there are different purposes. Everybody has different purposes, and for every purpose there is a different method that we normally analyze and understand. So we're going to talk about that in more details. So in a nutshell, we can group all these objectives into four. One is we would like to analyze the profitability of the company, whether the company is achieving its budget, its target, its growth, is but that means only the operational aspect. So at the moment, this part does not include the return ratios. It includes only the profitability of operations. How profitable are the company operations compared with its targets or compared with its competitors? Then but that's only internal part of the company operations. From investors point of view, they may not be interested in how profitable is the company. They are more interested in how much returns they are getting on their investment. If they have spent $10 whether the company is achieving 90% profitability or 10% profitability. Matter for them is what is the money that they are getting on their investment capital. If they have invested $100, how much they are going to get? Are they getting 2%, 5%, 10%, 20%, and whether it's sufficient or not? So that's mainly concerned with the investors, existing investors and potential investors. Apart from this, the managers and the employees are also interested to understand whether the operationally we are efficient or not through looking at the financial numbers. Now there are multiple strategies that you can apply, like maybe you want to collect faster, you want to pay faster, you may want to have a very quick and fast inventory system, supply chain management system. But whether it's efficient in terms of financial numbers or not, how will you compare that against another company, right? So you need some way to gauge how fast and how better you are compared to your competitors, compared to your targets. How will you measure that, whether the supply chain strategies that you are applying its work or not? So those comes with under this segment of financial statement analysis, understanding operational efficiencies. Then you want to then there are partners who are interested in liquidity and risk in the companies, especially lenders, consumers, supply chain partners. They are more interested in other than the three, whether the company is profitable or not, or whether the company is able to return good money or not. What they are interested in, whether the company will be able to pay the interest on time, whether the company will be able to pay their dues on time, whether the company will be is going to sufficiently survive for a longer period of time to pay to stay on to their commitments. So that's the liquidity and risk in the company. So there are certain segments of financial statements analysis which are dedicated to achieve this particular objective. Then there are performance compared to the market. Now all this alone cannot be sufficient to understand whether the company is doing its maximum potential or not. There are performance which when we where we compare against the market or against the competitors, against the industry averages. There this is the last objective that we want to understand from financial statements analysis. Now understanding these objectives is one thing, and how we are going to do is another thing. So let's look at how we do it. So there are three basics of analysis. One is we use analytical tools. So there are multiple analytical tools in financial analysis, especially vertical analysis, horizontal and ratio analysis, which we are going to look at, and then comparatives. Again, we will be covering them when we are looking at the three methods. The analysis also involves transforming the data. Now, what does it mean by transforming the data? You have a P&L, how will you transform? The transformation of the data requires you to be able to convert your P&L in whatever format it is to a format which is where your budgets are, where the other competitors are. So there has to be some kind of standard transforming standard data. You may want to compare your data against the targets. So you may have to transform either your data or the industry data, because not all are same. They may not follow the same accounting principles. They may not follow the similar methods. They may be under different IFRS, a different one may be following US GAAP, one may be following IFRS. So you cannot just compare them directly, right? So you may have to transform either of them to be on the same page. So that involves transformation of the data and reduces the uncertainty. There is always a uncertainty in the financial statement analysis, because the data is sometimes made of assumptions. So we normally, when we are doing the analysis, when we are preparing the financial statements, we always keep a margin of error in our mind, that it may be plus minus 5% off, or we do a sensitivity analysis. What if the growth rate is changed? What if the new sales change to certain percentage? What if there is a margin of 5% error? How it will change? So there is always a sensitivity analysis that we take care of it in the basis of analysis. So we will try to cover that time permitting, but we will be focusing more on application of analytical tools here. Now, what information you need for the analysis? So there are multiple aspects of financial statements, which includes balance sheet, income statement, statement of cash flow. So these are the three main statements that are mostly useful for understanding the financial statements. Then there are notes. Notes are usually ignored by most of the analysts, but it's one of the important aspect of the information, because income statement normally present only the consolidated numbers. Like for cost of sales, it will consolidate the numbers. Selling and general administrative expenses, it will consolidate the numbers. It's the notes where you are going to get the most of the data, the detailed data. Even notes does not have all the data, because all not all the companies are, there's no standard prescription. For example, like balance sheet, it will be segregated into the current assets, non-current assets, non-current liabilities, current liabilities, equities. There is no standard for notes to what kind of information they will contain. It depends on the management judgment, what they feel is important to provide there in order to understand the financial statements in a better way. So it's highly subjective, and because it's highly subjective, it have a different format, and it may not contain all the information. So you may need to go beyond the notes and beyond the presented financial statements in order to get the details of anything that you may want to know more. So we will be highlighting during the slides where you may need to get additional source of information, which is not may not be presented in the financial statements, standard financial statements. Right. There are, apart from the information which may not be provided by the management and is subjective, there is certain information which definitely is not available in any kind of financial statements. And but it's very important to understand the operational and efficiency of the company, the valuation of the company, and the performance of the company. So what are they? They are consumer list and the goodwill in the business. So the company maybe have just started, but so they consider a scenario of two companies which has one company has been in operation for 1 year, another company has been in operation for 5 years. The company A, which is 1 year old company, has a much better consumer list, much better prospect list than the company which is running in 5 years. So even though the company which is just only 1 year old may not be providing any profits, but they have a much stronger potential of inquiries or potential business, because they have higher goodwill or higher consumer list in the market compared to a company who is 5 year old, right? So even though the on the financial statements it looks like one company may be more profitable, but which company has better prospects, it's defined by what goodwill they have now and what are the prospects, what are the consumer lists that they possess. So that's one of the aspects which financial statements does not contain. There are future earning capabilities defined by the orders, defined by the product superiority, defined by the ability to command the market in the future, or ability to innovate for new solutions in the market. That is also not available in financial statements analysis. There is some information about the general plans of the company in management discussion and analysis, which is like prepared by board of directors and presented together with the financial statements as a part of annual report to the shareholders. But non-listed companies are not required for to provide that kind of information. So that information will never be available. For public companies, yes, it may have. Now, the management talent and workforce skills are also not listed or not available in the financial statements. At the moment, there is no method how we can evaluate the management talent and the ability of workforce to carry out certain things. So that information is also not available, and there is no metric to measure that. Good industrial relationships, maybe one company may have a much better relationship than the government, with the governments or with the key partners than the other companies, and that's why many companies are being sold and purchased or acquired based on what they possess. They may possess a very high consumer list, they may have a very good talent, they may have a very good industrial relationships in their in their business, which may help the company to generate more profitability in the future. That's why, but this information is not available in the financial statements. You will not be able to understand it from there. Real economic value of fixed assets. Every company has a fixed asset, but the shortcoming of most of the financial statements is that the financial in the value, the fixed assets are valued at historical cost, means the purchase cost. So if you purchase some asset at $10,000, even and you are applying depreciation on it on a yearly basis, maybe after 5 years it may go out of value in the books, but it may still have its economic value, which is being means that you still be able to use it and get advantage of it. But in the balance sheet or in the financial statements, it does not contain anything. Now there are certain financial standards, accounting standards, which allows the companies to evaluate or revalue their fixed assets and record them based on the real economic value. But there are very few companies who follow them, because it's very expensive to continue to do the valuation or revaluation of the fixed assets on a yearly basis. Plus, it contains quite a bit of flexibility, quite a bit of instability in the values, fluctuations in the value because of the changes in the environment, right? Changes in the economy, changes in the political environment, changes in technical environment. So the value keep on changing very fast. So many companies, they don't use this method. Then brands, logos, trademarks, which are built up inside the business. Now, the companies may buy, let's say, if you buy Nike and you pay a $2 billion for Nike, then in your balance sheet, you will have a brand Nike, which has a cost of $2 billion. But in the balance sheet of Nike itself, there is no value of Nike brand in their balance sheet because it's made up in-house, right? They did not purchase the brand, they build up the brand. Now if they want to sell it, it may be valued at $2 billion, but in the balance sheet it will not look like anything. So that's the another shortcoming, which does not contain any brand logo value of the trademarks in the business, right, which are developed from in-house unless you purchase them. Then similar way, copyrights and patents, they also are not produced, not built up in the business, or also not recognized in the financial statements. So you will say there are so many critical things which are not recorded in the balance sheet. Then why we do the analysis of balance sheets, right, or in the financial statements? Well, the answer to that is that the financial statement still contains very important and very critical information about the operations of the company, how the current operations are being carried out. It may not give you a very good idea about the future abilities of the company, but it will give you a very good idea how the past operations of the company has been performed. What are the key metrics where you can improve the operations and the profitability of the company? So we're going to look at that now. So there are few standards that we normally use for comparison or in the financial statements analysis. One is intercompany and intra-company analysis, which means that I will look at the metrics is defined within the company. ममता चुप हो जाओ. Now, there are intra-company requires, right? Which means that we may have set up some budgets, we may have set up some internal references, we may see the performance last year, we may see the performance of the different departments that we have in the company. So that is intra-company to compare. Then the next is outside the company, which is immediate competitors. Now you may want to see the gross profit ratio compared with your direct competitors who may have follow the similar business model. So there you can compare against the competitor. Then the third level of the comparison is with a wider industry within the particular industry. So airlines will be comparing with whole airline industry. So we will maybe take 5 or 10 big companies which represents 80 or 90% of the industry, and look at their all the ratios and and prepare an average that will form the basis of every other company to say that whether they are in line with the industry benchmarks or they are away from the industry benchmarks. So that's again one another layer of comparison. And the fourth layer of comparison comes from the guidelines. Now guidelines means industry standards. Industry may be achieving their own standards, or they may not be achieving their standards, but there are certain good principles or good numbers to achieve. For example, like current ratio. Usually, you will say the guidelines are 2 to 1, right? $2 of current assets for every single dollar of liability. It may be a guideline, but industry average may be different, competitor may be different, your own company can be different. So it just gives some broad idea about the whether the number makes sense or does not make sense. So the first layer is always intra company, within among your own set guidelines, set budgets, set targets. Then we look outside the company to the immediate competitor. Then we look at the industry, and then finally we look at the guidelines. Now, the tools of analysis are three tools, as we can say. One is horizontal analysis, where we compare the company's financial condition and performance across the time. We will look at the previous time, right? So that's why it's called horizontal, because in the financial statements, you will see horizontally, you will see year one, year two, year three, and sometimes in management accounts, we look at the budget, or we look at the forecasted P&L, forecasted numbers to compare against the actual performance. So that's called horizontal analysis. We will look at that in more details in a bit. Then the second thing is vertical analysis. As it says, it goes from top to the bottom. So how we do that? It is done by comparing a company's financial condition to a base amount, and that base amount usually is the revenue, the total revenue of the company for profits, and total assets for the balance sheet. So we compare each and every item, each and every line in the profit and loss statement to the total revenue and compare the percentage out of it. And then we look at this number and say, okay, how much is it percentage um, to the company, to the revenue, and then we compare usually with the previous years, or we usually compares with the competitors. Vertical analysis is very, very important when we are comparing against non aligned, like non similar competitors. Let's say we are our revenue is 10,000 $100,000 in a year, and we have a competitor who may be earning $1 million a year. Now their marketing spend and our marketing spend will definitely be not balanced, because they're 10 times bigger than us. So how do we know how effective we are in terms of marketing spend? The easiest way is to look at it as a percentage to revenue. So we will compare our revenue versus the marketing spend, and we will compare the competitors' market spend against their revenue, and we'll see whether that percentage which comes out is making sense or not. So that's called vertical analysis. In vertical analysis, we eliminate the difference of scale. So difference of scale means the revenue scale. So one company may be $1, another company may be $10. By doing the vertical analysis, we remove that gap. Horizontal analysis does not remove that kind of gap, right? So because it's compare apple to apple, dollar to dollar. So whether we make it will compare $10 with $100. It will not convert $100 into one and $10 into one. So that's the difference between the horizontal and vertical analysis. Then the next one is the third one is using the key relation ratio analysis, using the key relationship among the financial statement items. Now, two vertical analysis and the horizontal analysis look at the financial statement as its own, as a standalone, right? It does not it does not look at the relationship between the balance sheet and the profit and loss statement and the cash flow statement. Ratio analysis is something which involves other metrics than which are mentioned in the financial statement itself. For example, looking at the asset turnover ratio, when you take assets from the balance sheet, revenue from the P&L, and then merge and then make a relationship with them to see whether we are utilizing our assets in a proper way or not. For example, like looking at the pricing ratio, number of quantities sold compared to the revenue. So now that is again a ratio analysis. Ratio analysis are conducted within the information available in the financial statements, or sometimes we involve outside information available as well to the analysis. So ratio analysis is one of the key important factors in understanding the financial statements, and we're gonna be looking at in a much more deeper details. Now let's look at the how we use the horizontal analysis. It's a very simple one, so we go a bit fast. If you need any question to be asked, you can post in Q&A, and we will be able to help with that. So let's look at the sample P&L here. We are looking at Clover Corporation, where we have the results of 2004 and 2003 of the balance sheet. Now, the horizontal analysis can be used for balance sheet and for P&L. The concept remains same. So, how is it done? So, we add two columns to our profit and loss statement. One is dollar change, one is percentage change. So, we calculate the dollar change first by looking at the current year from the base year. So, the formula is always current year, where which we are going to analyze, versus the base year. So, the base year here is 2003. So we will use 2004 minus 2003, and then we calculate a dollar change, right? So that's the dollar changes analysis period minus the base period amount. And then the percentage will be dollar change divided by base period. So that's the formula. So here you will look at the screen, is the first line is calculated 11,500 negative. Now negative means because when it's lower than the last year. So if is a your personal preference, you want to put in negative, you want to put it in brackets, or you may not want to use any sign like minus or bracket. You just want to put it to red. That depends on the personal preference of the company, but the result remains the same. So if the number is lower than last year, it will always be, mostly it's in brackets. If it's higher than last year, it will be in positive. Then the percentage change will be dollar change divided by the base period. So which is 2003, 23,500. So 48.9% divided by 23,500, which becomes to 48.9%. Now that's how we will calculate the other values as well. So this is, we will calculate the other values similar way. So this is how we can get the dollar. Now how do we know what are the indications from this horizontal analysis? But horizontal analysis will just only tell you that which lines are higher than last year and by how much, lower than last year and by how much. That's the only information which is available from the balance sheet, from the horizontal analysis. It does not compare the relationship whether it should increase or whether it should not increase. Now the question is whether we should increase. Now for example, if you say account receivable has increased by 20,000, is it good thing or bad thing? You don't know about it because it does not give any other context, right? So now for this, we need to look at our sales, whether our sales has increased or not. If the sales has increased also, and then the revenue and then the accounts receivable has increased, it may make some sense. But the better sense it will compare when we look at the combining these two, accounts receivable and the revenue, and see whether it has increased or whether it should increase or not, whether our account receivable turnover ratio has increased or not, or it has decreased, right? So then only we will be able to say it's good or bad. And then the next stage can be to compare against the competitor, and then the next stage can be to compare against the industry to make sense whether the number which we are achieving makes sense or not. Of course you will be also comparing against your internal standards. For example, how much is the account receivable days that you are allocating, you are allowing your customers. If you are allowing 30 days and the account receivable holding days comes to 50, it's wrong, right? Or is something is wrong and your credit policy may not be working. So these are the indications. So the horizontal analysis will just give you the indication that certain lines are better than last year or worse than last year, and how by how much. But it does not tell whether it's good or bad because there is no other context available to it, right? uh, Now we can look at that. This is the next part of the balance sheet where we look at the current liabilities. The formula remains the same, it does not change. um, so in the next one, before we will look at the trend analysis, but before we move it, Let's do a very quick check on the poll. The first question: objectives of the analysis of financial statements includes what? Does it includes comparing to performance, comparing to the market, analyzing the profitability of the company, operational efficiency, and all of the above? Yes, that's the good answer, and that's the right answer. Thank you very much for participating in the poll. That's the right answer is all of the above. So company performance includes all of the above. Thank you. So now let's look at the trend analysis. Now, what is trend analysis? Trend analysis is looking at to reveal the patterns in the data covering the successive periods. So the trend percentage is calculated using by analysis period amount divided by the base period. Now there are two ways of conducting the trend analysis. One is we will have a same base period for all the trends. Let's say we are looking at 5 years performance, right? So let's say we are looking at 2020. So we can compare against 2011, 2019, 18, 17, 16, and 15. So the base period can be fixed at 2015, or the base period will shift to the next successive years whenever we are changing the financial year. So for example, 2016 will compare again 2015, 2017 can be compared against 2015 or can be compared against 2016. So when we compare with the immediate previous year, it gives us a trend line. What is the successive growth, right? When we compare against a fixed amount, it just gives us the total accumulated growth over the last 5 years. And then we need to calculate the annualized growth. How much is per year? So there are two different methods of trend analysis. In the financial statements, the most useful is successive years. So looking at the performance of immediate previous year to understand what is the trend, changes period over year, year over year, year over year. So that gives a better understanding compared to a fixed base period. So that's the thing that you should be careful. Now, how do we do that? Here is the example. So we have revenues, cost of sales, and gross profit for last 5 years, right? 2004, 3, 2, 1, and 0. So how we calculate? The formula was, let's say 2000 is the base year. So 2090, 290,000 divided by 275,000 minus 1, and then we calculate the percentage. So we will know how much is it increased. So it increased by 290 minus 275, 15,000 over 275. So how much percent it is, right? So that's how we will calculate the trend analysis. So in this calculation, the trend analysis is 105%. And then the 2011, 2002, 2003, 2004, here we have assumed the base of 2000, the base year is 2000, it's not changing, but we could change that and we could use 2001 for 2002 and 2003 to for 2000, 2002 for 2003 and 2003 for 2004. So we can look at that, and then we could have convert that into a graph chart, line graph, to see which year is increased, which year is decreased. Here in this particular case, every year is increasing, which is obviously because we are using only 2000 as a basis, right? So in financial statements, this does not give a very good idea. The better idea is to look at year by year successive rates, right? So trend analysis is a part of horizontal analysis because we are still looking at the successive in the previous year horizontally into the last years, right? Now let's look at the vertical analysis. So what is vertical analysis? Vertical analysis is we calculate a common size statement. So it's also called common size statement. And the way to we calculate is analyze period divide by the base amount. So here is we are not mentioning about the period. Here we are mentioning about the amount. So for balance sheet, it's the total assets. For income statements is going to be the revenues multiply by 100%. So that's the formula for calculating the common size statements. The common size statements is most useful for P&L, not so much for balance sheet because the balance sheet composition keeps on changing, but it's just give you a overall indication that how much percentage, what is the proportion of my assets as a percentage. So continuing with the previous example, we can say the total assets are 315,000 for 2004, and then now 12,000 over 315,000 comes to 3.8%. And similarly we can calculate for 2003, it comes to 8.1%. Now, is it 3.8% is a good number or 8.1% is a good number? There is no standard for that. It depends on the company policy. What is the right number? Or with the industry average, right? For example, the land or the buildings out of total property, plant and equipment compared to the total assets are about 50%. Now, 50% is good or not? It's a give and take, right? Because the higher fixed assets you have, I mean, the lower current assets you have, the better will be your return on investments, because uh, the current assets does not really help in generating the returns, right? They are more of a investment. So that's why most of the companies are trying to reduce their current assets by having the lean supply chain, and lower inventory, lower prepaid expenses, lower cash requirements, lower accounts receivable, so that the money that is invested into the company is mostly going to the production related assets, rather than going into the current assets. But for certain companies, current assets are more important than the fixed assets. For example, like service companies. So, looking at the so let's look at the vertical analysis of a P&L. That's more interesting compared to the balance sheet. Now, the formula remains the same. Uh, we just need to divide every line with the total revenue. So 520 divided by 520 becomes 200%. But cost of sales 360,000 compared to 520 will become to 69%. Now, if we are comparing against in the horizontal analysis, what we would do, we would 520 minus 480 becomes 40,000, and then we would look at the percentage. Similar way, we would look at the cost of sales, we would look at the selling general expenses, we would look at interest expenses. And the by the formula, we say that if the number is lower, is good. If the number is greater, it's bad, right? So here we would say selling administrative expenses has increased. Now, it may then if you just follow the horizontal analysis, you will say this is bad because the number has increased. But when we involve the vertical analysis, where we compare against the common size statements, now you will look at selling and admin expenses are 24.7% compared to revenues, where last year it was 26.3%. So if we look at the similar operations, selling and administrative expenses are actually lower than 2003. So it gives us a different scenario compared to the horizontal analysis. Now, which one is better? Obviously, when we look at the different common size, then the number which is shown in vertical analysis, have a better influence over a decision making. So we will say the selling and administrative expenses are actually lower. Now, you can also say that certain expenses are usually fixed, right? They are not related with the revenues. So you may also need to understand whether the selling and administrative expenses are fixed or are related with the revenues. If they are not related with the revenues, then no matter what revenue is there, the should remain fixed. And if the expenses are not remain fixed, it should not, and then even if they increase, then it's a problem. So you need to really understand how the business model of the company works before we make a judgment that the higher expenses are good or lower expenses are very good bad. Now, you can say the interest expenses here are reduced, right? 1.2% compared to 1.5%, and in absolute numbers also is 6,400 compared to 7,000, so it's less. But we are comparing only against the last year. We are only comparing against the as a revenue percentage. But what about the comparison to the total loan amount? What about comparison to our target? That, let's say our target was to reduce interest expense to 5,000 only. So we are not meeting there, right? So the financial statement analysis, the reports generally present what we want to present, not what it actually is. So you need to be careful and understanding that. I need to understand what are the budgets, what are the is there any target, what it should be. Then only you will be able to say it's good or bad, right? So the common size usually is compare make out of one, so divide from one pie one to the other expenses. So here in this example you can say that cost of sales is 69%, selling and general is 24%, interest expense is 1.2%, 1.4%, and net income is 3.4% of overall pie. We don't really generate the graphical analysis usually for of the for financial statement vertical analysis, but here is we are just showing you from academic perspective. Now the again one more question that we would like to go before we move over to the ratio analysis of our part. So tools for the financial statement does not include what? Does not include horizontal analysis, does not include vertical analysis, does not include ratio analysis or circular analysis. That's right. So it does not include the circular analysis. That's a good answer, correct answer. Okay. And then let's look at one more question. Trend analysis is used to reveal what in the data? Differences, latest technology, pattern, or none of the above. So the poll question number 3 can be. So what does it reveal? It reveals the difference. It reveals the latest technology. It reveals the pattern, or none of the above. Okay. Yes. Again, you're right. Thank you very much. It reveals the pattern in the data. Okay, so now let's look at the important aspect, very important aspect of the financial statement analysis, which reveals most of the information in the ratio analysis. Is the ratio analysis. So what is the ratio analysis? The ratio analysis has no meaning in itself. Usually, ratio analysis does not mean anything because it's just a comparison or a relationship with the another, unless we compare it against some benchmark. So we need to have a benchmark for making sense of the ratio analysis. For example, in the previous example, we were saying that selling and general expenses are 24% of revenue. That's a ratio because it describes the relationship of the selling and general expenses to the revenue. Now, does it have any sense? It does not have any sense unless it's compared against a benchmark. So in the previous example, benchmark was the last year expenses, which were higher than this year, right? So it means we can say, yeah, we are good, but it may not be the only benchmark. There may be another benchmark of the target. There may be a benchmark of budget. There may be a benchmark of the competitors. There may be a benchmark of industry average. So it has to be compared against some benchmark in order to make sense. Uh, it can be compared against the competitors, but we need to be cautious on how the accounting and the business model is different from the competitors. No two competitors are same, because every competitor trying to differentiate themselves with the other competitors, whether in terms of pricing, product, business model, the processes, everything. So we need to be very cautious when we are comparing the ratios with our competitors, because the differences in business models, differences in accounting policies, differences in the products can make the difference in our results as well. We can compare against the previous year, but again, we also have to be very cautious because the accounting policies may change, accounting standards may change, the way of we are doing the business may also change. So we need to be careful when we are comparing against the previous years itself. So the another thing that we have to remember is ratios are not conclusive evidence. They are just indicative of symptoms. So when you go for, if you are sick and you go to a doctor, doctor will measure your temperature. So the temperature is not a problem. The temperature is only an indicator. So similar way, ratio is an indicator. Doctor may say you have 104 degree of temperature. That's a ratio. That's a number that is going to tell you you have a problem. But what is the problem? You have to have further diagnostic. You may have to get some more tests done. You may have to get details of the GL. You may have to get details of the transactions in order to understand more about the problems. And definitely business models accounting practices affects the ratio significantly. So you need to be careful before you reach conclusions, especially when we are comparing against the previous years, comparing against the competitors, because the changes in business model and changes in accounting practices will make it different, and we will show you some examples how they make it different. So there are four main categories of financial ratios analysis. Uh, it's called liquidity and efficiency ratio, where we look at the liquidity of the company, whether it's able to use its resources. Then you have solvency ratio, means the debt ratio or the risk ratios. Then you have profitability ratio, which are just showing only the operational efficiency of the company, and the market ratios. So we're gonna be looking at these key ratios in a little bit. So the key profitability ratios are four. So there are multiple other ratios. I have not included every one of them here. I've included only key ratios here. The formula that we are showing in this slides are can be different from for other businesses, and the names of the accounts can be different. So you have to be careful and when apply the formulas. So the first is the gross margin ratio. The gross margin ratio is usually calculated by the total revenue, gross revenue, of course, minus the VAT or taxes, minus the cost of sales, so that you get the gross margin divided by the revenue. Now, what is the cost of sales? The definition of cost of sale can be different for different companies. So you have to be careful when you are comparing against different. For some, cost of sale may just include the cost of production. For some, it may include labor. For some, it may include the branding. Some, it may include the transportation. Some, it may include a distribution margin. So you have to follow the industry standard. For example, like in hospitality, the cost of sales means the direct cost, which is required to make the sale happen. So if there are any fixed costs which the entity has to incur, no matter whether we make a sale or we don't make a sale, it's not considered as a cost of sale. And cost of sales means cost of selling is not included. Cost of sale is only included. So cost of selling is a different thing. Cost of sale is different thing, right? Cost of sale includes the product cost divided by the revenue of the company. Then you have operating margin. Now the gross margin will just only tell you the pricing efficiency of the company, whether what is the margin that the company is putting on to the cost of production or the real cost of sale, direct cost of sales, direct cost of goods, right? So you can use this ratio to compare the pricing strategy of two companies. When you compare this and one company's gross margin is higher than the other, it means that first company is trying to not fight on the pricing, right? They are not on the price war. They are trying to maintain their prices while providing the quality. That's general impression. If the margin is low, it means the company is going after the volume. They want to sell more by keeping the prices lower. They are mainly competing on the price of the product. So that tells a lot of things. So comparing the gross margin between competitors, gross margin compare against the industry's averages, or comparing against the previous years, help to understand what are the strategies of the company, whether they are going for volume or they are going for value. Then it comes to the operating margin ratio. So what is the meaning of operating margin ratio? Operating margin usually means revenue minus cost of sale minus operating expenses. Now again, operating expenses will also all include your selling expenses, general expenses, administrative expenses, distributor profit, transportation, everything. Divide by the revenue. So you may have different account codes in your P&L, so you may need to look at that. But the general definition will be revenue minus cost of sales minus all operating expenses related with the operations of the company, normal operations of the company. There are many things which are not considered as operating. Now interest, for example, in many companies, interest is not considered as operating expense. Interest is more of a financing way. So it is not included in the operating expenses. For some, it may be, right? For some banking industry, this is an operating expense. So you have to. That's why we are not giving you the name of the accounts itself, the name of the expense, rather than as an operating nature. For some expense, for some companies, rental may be operating expense. So for some companies, rent of the offices or the buildings may not be a operating expense, because that's more of a financing expense. So you have to be careful in what is operating expense or what is the normal operations of the company. So similar way, revenue will also be only operating revenue. If there are any ad hoc income or expenses which are not related with the operations of the company, you have to ignore, you have to remove them from ratio analysis. So the operating margin ratio helps to understand what are the operating margins of the company. Now it may be different based on the different models. So here you will on the screen, you will see there are four companies which has different models, and their gross profit margin are their operating margin are similar, but their gross profit margin is different. So the company A, we are assuming, is a hypothetical example, we are assuming is going to produce their own goods. They are going to market themselves, and then so their gross margin is, cost of sale is 3,000, gross margin is 77,000, then the gross profit margin is 70%, operating margin is 30%. Now the company B is not producing itself, it's buying from outside and then selling it, right? So they are outsourcing the job. Profit remains the same, but look at the gross profit differences. So now the gross profit has reduced from 70% to 40%, but the operating margin remains the same. Now you can say it's a hypothetical example. There may be when you are outsourcing, there are the cost of sale may be higher or maybe lower. So that's a but we are not considering those differences here. Then the third company's model is that they are just only into the trading. So they are also doing the same. They buy from somebody and sell to somebody else. But they are not via distributorship. So they don't really care for the selling. So selling expenses or rebranding expenses. So again, their profit remains the same, but the cost of sale increase because they are not doing the branding. They are not selling by themselves. They are just like a trader, right? So their gross profit margin reduced to 30%, operating margin remains at 30%. Now there is another business model where we say we are acting as an agent only and we are earning the commission by selling it. Same thing, same goods we are selling, but our business model is different. So we are still earning 3,000. We are still earning 3,000. But in that case, our revenue will be 3,000 because of the accounting practices. We have to recognize only the commission income as an income, and the cost, there is no cost of sales, assuming there is no cost of other administrative expenses. So the operating margin remains same, 3,000. But now look at the GP ratio as 100% and operating margin also at 100%, right? So that's the difference between the different ratios. The business model and the accounting practices will make the ratios look completely different, and you need to be very careful about that when you are comparing cross companies. So that's an example on the ratio analysis. Now let's look at the, so this is another example. Let's not look at that. Now let's look at the net profit ratio. So the net profit ratio will be similar, where we are saying that revenue minus cost of sale minus operating expenses minus depreciation and minus interest also, and usually the taxes. So it includes everything else, the whole company expenses, and then we calculate the net profit. So the net profit is just telling you that what is the net income to the shareholders. Now again, net profit may be different for different companies depending on how they are financed. Some companies may invest all of their assets, but may finance all of their assets by their own money, means they may not have any interest, but the other company may have an interest, right? So their net profit may be lower than the company, other company A or company B. But whether they are more efficient, whether they are less efficient, it does not, the net profit ratio will not tell you that, right? Because they are different finances and they are, but the company's operations has no impact on, are not different, they are same. The depreciation will also be different, can be different by accounting policies. So one company is charging straight line method, another company is charging written down value method. So the net profit ratio for both the companies will be different, even though the actual performance of the company is the same, right? So when you are using the profitability ratio to compare different companies, you need to be careful. Now, here is an example of the same scenario which we used earlier. Let's say the age of the company, different age of the company. So one company is 2 year old, another company is 5 year old, another company is 10 year old, and one company does not owe any asset. So in that case, their depreciation will be different. So their expenses, their net profit is also going to be different, and their net profit margin ratio will be different as well. Now it does. Even though their operating margin is same, their net profit margin can be different, and it will show a very different picture when you are just comparing them without understanding that their ratios, their business model, their accounting policies are different. So you need to be careful on when you are comparing what are the accounting policies, how they are charging the depreciation, how old is the company, how they are financed, and whether they are using the assets by themselves or they are using the or lease assets. So the different business model will give you different profit. To avoid these differences, what we look at the return ratios. How much is the return that they are generating on the capital ultimately employed in the company? So the profitability ratio can help you understand the performance of the company within itself. It cannot help you to compare against somebody else. So that's the nutshell of this discussion, because the different business model will yield you different. But if you are changing the business model along the way, then also you cannot compare, you cannot rely on the historical numbers as well. So you need to rely more on the current targets, the the current benchmarks which you have to follow, right? So there are, apart from these three ratios, there are some other expense control ratios which we normally follow, which includes selling and administrative expenses to revenue, which helps to understand how much money the company is spending on the key activities, selling expenses, right? But the selling expenses, when you are comparing, also you need to be careful and understand that the selling expenses are usually not relate to the current revenue only. Selling is usually done for the next year sales or next to next year. So if even if you are spending more this year, it may lead to a better results in the future. But while looking at the percentage this year, you may get a wrong impression. So what you want to look at is, you want to look at the orders on the books, right? When you want to compare the sales expenses, administrative expenses to revenue, it varies whether they are fixed or whether there is there any relationship to the revenue. If there is a if the revenue if the administrative expenses are supposed to be fixed, then the ratio will not help. Then you have other important item is research and development. Usually the companies spend a bit of their revenue on the research and development for future. So you have to be on lookout when you are doing the financial analysis of any company, whether the company is spending on research and development or not, right? Then there are other practical ratio of the profitability ratio. Is it helps to explain the competitive advantage adopted by different companies. Let's look at one of example where we compare Apple and Dell in 2007 and 2008. So here you have Apple 2008 and 2007, and Dell 2008 and 2007. So the COGS of Apple is 66%, while the Dell is say 80%. So which one of them is a cost leader? You would say the cost leader is definitely Dell, because their margin on their sales is very little, is only about 20%, while the Apple is charging 35%. So the Apple is following the product differentiation, because when you follow product differentiation, you don't have to sell cheaper, you have to sell higher, right? Because you are charging for premium. But Dell is mostly targeting to become a cost leader, low value products, high volume strategy. That's why their profit margin is lower, right? then the gross margin is there, and then you can look at the selling and general expenses. Both the companies are pretty much the same. They are spending about the same amount of the money, but does it mean that they are same? It may not be, because the Dell may be spending more on institutional sales, Apple may be spending more on direct to consumer sales. So that's the difference, right, in between the two companies. R&D, the Apple is spending much more than the Dell. It's almost three times if you compare against the percentage of revenue, right? Because you can tell Apple is a product differentiation company, Dell is more on a cost leader. So their research and development is more on to generate the efficiencies within their products compared to the product differentiation. So the operating income is much different from the in for Apple compared to Dell. But does it say that Apple is a better company or Dell is a better company? But you cannot tell that, because it's just a profitability ratio. We have yet to see the return ratio, whether whether the Dell is returning more money to their shareholders compared to Apple or not, right? So that's another thing that you might have to consider. So for that, we need to calculate the ratios. So here's another example of another industry which is similar way, American Airlines versus the Southwest, where we can see that the operating expenses of Southwest is 79%, while American is at 89%. So Southwest definitely runs low cost. It's a low cost airline. It has lower cost. So that's why their cost of sales is lower compared to American Airlines, which is a full-fledged airline, and they have more expenses compared to the Southwest. So their EBITDA is different, their interest is different, the net profit margin is also much different, right? Southwest is much efficient compared to the American Airlines, and you can see, but American Airlines has a revenue of 44 billion dollars compared to 21 billion dollars of Southwest, but the net income of Southwest is better at 2.4 billion compared to 1.4 of American Airlines, and that's why Southwest is considered as the best in terms of efficiency. So the ratio analysis helps to establish that factor easily in quantitative measures, right? Then the next thing, as we discussed, that profitability ratios does not give the entire picture of whether we are more efficient or not, because profitability can be higher, but if the return on the assets, return on the capital employed is lower, it's no use. The higher profitability is no use if the money invested into the business is not being returned into a proper fashion, right? So that's measured by return ratio. So what are the return ratios? So the key return ratios are return on assets, return on total assets, right? So the net income divided by the total assets. Here we use net income after depreciation, after the interest. You can also you add the depreciation back, because we are adding the total assets. Rather, depreciation is usually not a expense, operating expense. It's more on a provision of replacement of assets itself. So you could do that as an alternative, but commonly net income is used, net income divided by the total assets. So what it will tell you? It will tell you how much is the return on the generated by the assets, how much we are earning per month, per year, right? And you can compare that with the bank interest, with the other alternative investments, whether the company is being able to utilize their assets properly or not. Then there are return on fixed assets. As we seen in the earlier, the balance sheet, there were of the example, the fixed assets were 50% of the total assets. There are other assets like inventory, debtors, cash, which are may not be the able to produce that much of return. That's why a second variation of return on assets is generated as called return on fixed assets, as especially for manufacturing companies, where it's assumed that the returns will come from fixed assets rather than from the inventory and from the accounts receivable. So the return on assets, the formula is fixed assets formula is same, net income divided by the fixed assets, or you can say the production assets. Then the next is return on capital employed. Now, return on capital employed is going to be pretty much same as total assets because the total capital employed is used to buy the total assets, right? So it would be same, but there are some current liabilities and short-term loan that you might have taken. That's why another variation is called return on capital employed. And the another difference between return on capital employed and return on asset is that return on asset is calculated using net income. Return on capital employed is calculated by earnings before interest minus the taxes. So here, or in the other way, we say net income plus the interest portion. Why is that? Because the capital employed can be supplied by equity shareholders or by the debt shareholders. Now, when we say debt shareholder, what are they getting? Equity shareholders are getting dividend or the profits, and the equity and the debt shareholder are usually getting the interest. So when you want to calculate the total return on the return on capital employed, you need to see what was the equity share capital, how much dividend they get, means the net profit, plus how much the debt shareholders were there and how much they get, means the uh, interest portion. Since the interest portion for the company is deductible, so company has got some tax advantage, so we deduct the tax out of it, and then we say that's only the net profit plus the interest minus the tax portion on it. So that's called the return on capital employed. Return on capital employed is very important formula to tell you what are the differences, how well the company is able to use the methods of financing. So let's say the company's return on assets are higher, usually higher than the loan that we can get outside, and the company has taken a loan to increase more assets to generate more income. It means the total income will continue to increase, and the return on capital employed will be lower than the return on assets, or lower than the return on equity. But if the loan outside is higher than the return on the assets, then it's a problem, because then the return on equity will be lower than the return on capital employed, because overall they are getting more than the return on equity. So the difference between return on capital employed and return on equity will normally tell how well we are able to use our debt, or whether we are using any leverage in the company or not, because leverage usually helps to increase the return on equity shareholders. So return on equity shareholders is usually calculated by net income divided by the book value of equity investment. Now, book value of equity investment is for theoretical purposes, for the actual and to provide a stability into the business, into the calculations, because the market value of equity investment keeps on changing, and it's not available for non-listed entities anyways. So that's why we use book value of equity investment. But if we are looking at the analysis of public listed company from the perspective of investing into the company, then the return on equity will be calculated by net income divided by the market value of equity investment, so that we know what money we can expect from this company if we invest into this company, right? But if you are just calculating it for comparison purposes or for analysis purposes, you can use book value of equity investment. So the return on capital employed, as I said, is total capital employed from equity plus the debt, and return on equity is only on the equity. So usually, if the company is able to use the financing, or is able to utilize the financing and leverage, return on capital employed is lower than the return on equity, because the return on capital employed utilize the lower debt cost. In the other case, where the when the return on assets is usually lower than the capital that is borrowed, return on capital employed will be higher and return on equity will be lower, and that's not a good sign for the company. So that's what we need to do. Usually we can analyze that. So here is in this example, I have analyzed the three return ratios. One is the return on assets, uh, return on equity, and then we can see how the leverage affects the company, right? So here you can see that there are three companies: Xiaomi, Samsung, and Lenovo, and this is 2018 and 2017. So what we have done is we have looked at the profitability ratio. So let's look at the profitability of Xiaomi. Xiaomi is at 12%, Samsung at 45%, Lenovo is at 14%. And we said if the gross profit or the profitability of the company does not matter if they are not able to return that into the equity shareholder. Now let's look at the return on assets. Return on assets for the company for Xiaomi is 9% for 2018. Samsung is at 13% and for Lenovo is at 2%. So it means that Lenovo has used a lot of assets into the company for generating that much of income. While compared to Samsung, Samsung is the best in the class there in terms of asset utilization. As you can say, the return on asset is highest in Samsung. But when it comes to return on equity, all the companies are pretty much the same: 18.9%. Samsung is at 18%, and Lenovo is at 16%. Now Lenovo is lower, and the reason why they are lower is because you can see the difference in the total assets. Total assets are 29 million, and the equity is only 4. So their debt is at 25 million, which is 6 times of equity. Compared to Samsung, the total assets is $308 million, 308 billion. Their equity is 225 billion, which means a debt of 75 B, or you can say about one third of the equity. So it's not that much, right? Compared to the Xiaomi is at 20 B compared to 10 B of the equity, which means $10 billion of debt, which is about the same, half, 50%, right? 100% of the debt. So same as equity. So Lenovo is highly indebted. That's why their return on assets is lower, but their return on equity is pretty much the same as the other, even though they are not really profitable in that sense, and they are not able to utilize their profitability as much as Samsung, but their return on equity is same because their equity itself is super low, and they are leveraging quite a lot from the market, from the others' money. That's why the return on equity is pretty much the same. So even though their profitability is low, their return on equity is fine. Even though the Xiaomi profitability is low, but their return on equity is fine because they are again using somebody else's money, right? So that's how the companies usually leverage the debt in order to increase the return on equity. But increasing the debt, it also increase the risk in the company. Now, if you have to invest in these companies, which company seems to be the safest? Obviously, Samsung looks safest because it has very high value and the portion of the debt is very low compared to the equity. While Lenovo, the debt is much higher in terms of total assets. If they fail to pay the interest, or if they fail for in the performance, they may not be able to survive, and all the assets will be taken by the by the debt holders. So you don't want to invest into this. You want to more invest into a stable company like Samsung, which is generating similar returns but giving you a much stronger sense of safety. So that's a general deduction from the data. But don't take these ratios at face value, because the ratios are usually calculated on the book values. Like the fixed assets is calculated at book values, which is going to depreciate over a period of time. Ratios are calculated on the net book value of the equity, which is not the same because the market price can be much different. So even though we look at the book values of the three companies, return on equity is same, but when it goes to the market, it may be completely different. So I have not done that. You can do it. You can try to see how does it make a difference. And then not all assets are used in the business, rather they sometimes they are used as an investment, or they may be used for internal consumption, or these assets may be used as a acquisition for future businesses, right? or as a matter of to just to keep the competitors away and generate more income on the other side. So depending on the composition, the ratio may not be directly available, so you directly comparable between different companies. So you might have to understand why the company's return on assets is lower, how they are using the assets, what are the rationale of acquiring the assets when the income is not increasing. So there are other methods compared to the just only the financial returns on the assets acquisition. Business model will affect the ratios. So outsourcing versus self production, retail versus own products. Like for example, Samsung, they may be very high on the assets because they keep high inventory. They own the stores, while the other companies may not own the stores. They may use the distributors to sell, which means their assets are lower. So the business model differentiate. If you outsource, your assets are low compared to the self production, but it may also affect your profitability and your return on equity or return on investments. So you have to consider those differences when you are comparing or when you are understanding the return ratios. Leverage will affect the return on equity, means the debt will affect the equity investments, because the debt cheaper debt will increase the return on equity but will increase the risk in the company as well. Now let's look at the then now after we have understood the profitability of the company and also the return on assets, we now can look at the operational efficiency of the companies. The operational efficiencies can be considered as a asset efficiency first, how well we are able to use our assets. So the way one way to measure that is looking at the sales turnover ratio. So the sales turnover is calculated by sales divide by the total assets. Now which total assets you are going to divide, to all the assets or only fixed assets? It depends on how you want to analyze it. The only thing you have to remember is you have to be consistent when it comes to calculating the last year ratios, benchmark and competitors. So whatever formula you use, whatever total assets you use, whether you include only the fixed assets or you include all the assets, means the inventory, the debt, the cash and everything else, you have to be consistent. Ideally, the sales divided by fixed assets is considered as the most useful ratio, because cash will not generate the sales. Inventory do generate sales, but and the debtors does not generate sales. Advances does not generate sales. Intangible assets does not generate sales. So you have to use the sales assets which are useful in generating the sales only, right? Otherwise, the sales ratio, the asset turnover will be biased. Then there are inventory turnover ratio, means how much you how often, how fast you turn around your inventory and how many days of inventory you hold in your hands. So there are two ratios. One is called turnover ratio, which is calculated by cost of sale divided by average inventory. Now it's used cost of sale, not the sale, because inventory is valued always at the cost, not at the sale price. So that's why the turnover is also calculated by cost of sale divided by average inventory. Now average inventory, how you will get the average inventory? Average inventory you can get by calculating the opening stock minus plus the closing stock of the year divided by 2, but that's very vague. So the better way is to calculate monthly averages. What is the end of the month stock for month 1, 2, 3 until 12, and then calculate the average. If you are doing it on a monthly basis, you can calculate the month beginning and month end divide by the 2. That's another way. Then another important, so this number, it will come as a number, right? It may come as a 1, come as a 2, come as a 3. It means that how many times we are able to turn around the same inventory value into the sales. So if it comes 1, means we are able to sell one product one time in a year. If it comes 2, means every 6 months. If it comes 3, means every quarter. If it comes 365, means you sell every day, right? So that's the value of that's the benefit understanding this. Now, the another aspect of this turnover ratio is inventory holding days. What is the meaning of inventory holding days? It means how many days of inventory we hold on an average basis. So the formula is 365 divided by the turnover, means the turnover we just calculated, or average inventory divided by average cost of sales, average daily, daily average cost of sales means how much is the average cost of sales per day, right? So that's the total. So that by this we know how many days of inventory we are holding in our hands. That will be help us to understand whether we are able to sell fast or not. Then you have accounts receivable days, same concept, same formula. Turnover will be credit sale divided by the average amount due from customer. Now here we are using credit sale because we are talking about the dues from customer, which is based on the sales value rather than the cost of sales. So the turnover will tell us how many times we are selling to one customer on an average, right? It does not say one customer, but it says uh, per dollar that we have invested into the customers, how many times we are able to sell. Uh, Credit sale is usually not available from the profit and loss statement phase. So we use total sales also because we don't know the credit sales. But if you are using for internal purposes, internal calculations, you will be able to know the credit sales easily. So you can collect that. Inventory hold account receivable holding days usually means how old how many days of account receivable how many days of sale is pending to be collected. Now it may come out, let's say 20, 30, 50. So it will tell you what is your collection periods on actual basis compared to what is your credit period on papers. So you can compare these two numbers and say whether you are able to collect in time or not. Then you have a similar way payable turnover, but it's calculated based on the credit purchases divided by or cost of sale divided by um, the average payables instead of cost of sale. Then the holding days will tell you the same thing, whether how many days of sales purchases we are still pending to pay. That you can compare with your credit period that you normally are expecting from your suppliers. Then the last efficiency ratio is cash efficiency. How much of the cash you are keeping in your hands. You will see many of the balance sheet will have a very high balance of cash that is held in their hands. Why they do it, it's a different method. They may have high balance because they may have want to want to buy a new company or want to invest into somewhere, or they may not find any suitable investment. They may be waiting to pay the dividends. They may want to share the purchase the shares. So there may be different reasons, but the ultimately what we want to look at the what is the cash efficiency, how much is the cash utilization expenses, and what is the cash in hand divided by average daily cash expenses. So average daily cash expenses means your how much cash you are utilizing. So you can look at from in cash flow from operations divided by 365. That will tell you how much cash you are paying on an average per day, and then you can compare that by cash in hand to see how many days of cash they hold in a daily on a daily basis. That's one way. So let's look at the three companies which we looked in our previous example, Xiaomi, Samsung, and Lenovo, and let's look at what are their ratios in this the one that we have discussed. So the asset turnover for Xiaomi is 4.46, which means they are turning for every dollar invested, they are making $4 in a year, and for Samsung is 1.48, which means they are only generating $1.48 for every $1 invested. Lenovo is 3.9, so Lenovo and Xiaomi are pretty much the same. Samsung is bit losing on that ground. Then inventory, the Samsung is has the highest inventory, $26 billion. The turnover is similar. 5 means they are turning around the sales by 5 times. So inventory holding days are also different, right? Inventory holding days of Lenovo is surprisingly very low compared to Samsung and Xiaomi. Samsung and Xiaomi has higher inventory holding days, means they are holding inventory for 70 days. Samsung hold for 80 days. Lenovo holds for only 29 days, which is very efficient, right? It can be said. We can say that. Account receivable is a different story for all the companies. Account receivable turnover means Xiaomi is not selling much on the credit. They are collecting within 12 days. Samsung is collecting on 51 days, so quite high, around 1.5 month. And Lenovo takes about 50 days to collect money from their supplier, from their debtors. So it tells different business model for the three companies. One company is selling faster, another company is collecting faster. Payables, all the three companies are same. They are all paying around 120 days, around 4 months to 5 months on an average. Cash safe, how much cash they are, how resilient they are. Average daily total expense per day are for Xiaomi is 61 days, so they hold 61 days of cash. If they don't sell anything for 60 days, they are fine. Samsung holds around 6 months of cash, means if they even if they don't sell anything, they are fine. Lenovo holds only 90 days of cash, means every 20 days they need to find a cash. If they don't sell for 1 month, they are bankrupt, right? So that's the way we interpret this. When the debtors or potential lenders or potential suppliers are going to look at it, they will say, oh, Lenovo may is a risky company, right? Samsung is pretty much safe, very safe actually. So that's why they may be able to command a higher rate, a better prices compared to the other companies because they are perceived as safe. So this is how we implicate the different ratios to try and understand what they mean in a different scenario. So the different business model will yield different results. We have to compare against previous year. As you can see here, most of ratios I have calculated previous year and also the competitors, right? So that's how the differences we are calculating. Okay. So operational efficiencies, have we considered all operational efficiencies? Not yet. There are certain assets which we have not talked about and there is no measure in the financial statements. For example, labor. What about the manpower efficiency? Is there any financial ratio apart from the payroll number, payroll compared to the sales? There is no other operation payroll labor efficiency that the financial statements concern. But it's important to understand, right? So that's why normally we consider productivity ratios as an example to calculate whether the labor force is efficient or not. So how we do that? So there are productivity ratios depending on what are the industries. For example, hotels, for housekeeping staff, we say how many rooms they clean per day. That's one productivity, right? For manufacturing, it can be how many products they are producing in 1 hour or per person on the factory. How many percent of the staff are related with the production directly? How many percent are in administration? For service industry, we can say how many customer calls they handle per person, how many hours they are served for a service industry, right? So that's different method of generating the productivity. So these are out of the financial statements, but these are very important ratios that the company need to analyze, right? So that they can actually generate what they need to know about their product labor, the main one of the main resources in the company, which is the labor force, right? Then there are other assets like intangible assets. What about the patent? Whether we are able to use all our patents or not. The manufacturing companies or the pharmaceutical companies, they hold thousands of patents, thousands of copyrights. Are they able to utilize all of them or not? What are the profits that are generated by each patent or by each copyright compared to the investment that they are making into this particular copyright or patent? So these are another extra information which we normally want to understand in order to analyze the company's performance, but which is not available in the financial statements. There may be many more. You can put into comments or you can put into the chat box here or in the Q&A. What are the other things that you think should be included in understanding company efficiency or operations apart from what we have discussed financially and non-financially? Right. Now moving forward to our fourth category of ratios, liquidity and risk ratios. Now the liquidity ratios are different types. So first we're gonna look at the liquidity ratios and then we look at the risk ratios. The liquidity ratio usually contains about the current ratio. How we calculate that? Simple formula: current assets divided by current liabilities. Now current assets include cash, inventory, receivables, divide by the current assets and current liabilities and accruals and provisions all. But you need to be aware that whether we are able to realize these cash inventory or not. Similar way, whether these liabilities are required to be paid or they are just a provision, means they don't need to be paid. But in a ballpark number, we include everything in the current ratio to calculate what is the how much dollars do we have for every dollar that that we owe, right? So that usually is the concept of the current ratio. Then the next one is, because since many of these may not be immediately realizable, so to be on a conservative side, we keep the denominator, current liabilities plus accrual, same, but we remove one item from this current assets, which is called inventory. So because inventory is difficult to sell and then you have to collect, so we take it out to calculate what is called quick ratio, and then we calculate cash plus receivables divided by current assets and accruals, and then we take out one more to calculate the cash or called asset ratio, which means only the cash or the cash equivalents which we know we have in our hands, divided by current liabilities and current accruals. Now there is no standard benchmark for what should be the ratio. Current ratio ideally in a guidelines, in accounting guidelines, should be 2 to 1. Quick ratio maybe 1.5 to 1, and cash ratio should be 1 to 1. That's the ideal ratio, but industry practices can be different. You may hold much lower cash than your current liabilities, but we need to have sufficient cash in our hands to meet our immediate requirements. Then there are risk ratios, which requires us to calculate long-term debt to equity ratio, which means how much long-term debt we have compared to the equity. Long-term debt divided by equity investment. This ratio will tell how much of the skin the company, the owners have in their own game, right? In their own company. If it's lower than 1, means good. The debt is low and the equity is more, it is considered as safe. If it's more than, again, 2 to 1, it's considered as a risky company. Total long-term debt to equity should not be more than 2 in ideal situations. Then you have total debt to total assets, means how much is the total debt we have and how many total assets do we have in order to repay in case of any things. So ideally it has to be less than 1, because means that your total assets should always be more than your total debt. Otherwise otherwise there's always obviously a risk that the debts are more than the assets, which means the company will not be able to pay off their debt. So that's again a ratio that we understand. Then you have a last one is interest coverage ratio, which means that how much our cash flow from operations is there to cover off the interest that we need to pay. How many times is it? When 1 time, 2 times, 3 times, 4 times, so that the lenders are safe and they are confident that the company will be able to pay off their interest on time. Then the cash conversion cycle means that how often, sorry, what is the company's ability to convert its cash in from sale to the cash collection. So let's look at the example. Oops. Yeah. So the operational use of ratio is that, sorry. Yeah. Okay. So we don't have an example of this one as of now, but let's look at the another topic, how we use these ratios. So if we want to understand whether your sale is and the dynamic pricing models are profitable or not, you want to look at the gross margin ratio. If you want to know whether all your sales are collected or not and your customers are reliable or not, then you need to look at your AR outstanding ratio, means the AR turnover ratio, which we just calculated earlier, and the AR aging. How old are your debts? If you want to know whether your business decision to lease versus rent or buy improves value to the company or not, you want to look at the profitability ratios. Whether if you want to use if you want to understand whether the your management of supply chain is efficient, then from customer side, you may want to look at your inventory ratio, how much of inventory you are holding. If you want to look at from supplier side, you want to look at your just in time delivery, again inventory ratio, and also the operating margins, whether your operating margins are good or not. Bad supply chain will reduce your operating margins, better supply chain will improve your margins. Then you want to do again other additional ratios or additional details of financial statements to understand different aspects. For example, sales, whether your sales team is efficient or not, whether your sales marketing activities are efficient or not. You may want to look at your sales ratios. You may want to look at your segmentation to compare against your targets. You may want to look at your sales turnover from productive assets. You may want to look at your customer acquisition ratios to the total cost, and the conversion ratio from the total customers achieved or total customers approached. You may also want to look at the cost of sales, operating margin, inventory turnover, inventory holding days. Uh, you can look at the collection and payments to understand the efficiency of finance operations, working capital ratios to understand the efficiency of finance and treasury operations. You may want to look at cash flow from operations towards the net profits in order to understand whether you are again managing the treasury function in a proper manner or not. Right. So these are the other operational analysis, other ratio analysis, which can help you to understand more about the operational aspects of your business. The last thing that we wanted to discuss was the dew point analysis. Is one of the ratio is a combination of multiple ratios which helps to understand whether the company is able to generate good returns for for the equity or not, and whether what are the reasons if they are not, and where they are better and where they can improve. So the dew point analysis is was introduced by the DuPont Corporation, and it breaks down the basic formula of return on equity, means net income divided by equity, into three different segments. Because income is dependent on sales, sales is dependent on the number of resources that we are inputting and are available to produce, and resources are available depending on the capital invested. So we break down this one ratio into three different efficiencies. One is uh, whether we are able to generate whether we are able to make money out of the sales, whether we are able to make sales out of our resources, whether we are able to generate more resources out of our capital. So there are three things. One is net income over sales, sales over total assets over total equity, means the capital. And this net income over sales is called net margin. Sales over total asset is called asset turnover ratio, and total assets is called over total owner equity is called equity multiplier. So whether we are able to make a profit out of our sales, whether we are able to generate enough sales, and whether we are able to generate enough resources out of our total equity, that will tell us where we need to be more efficient, whether we need to be more efficient in operations, whether we need to be more efficient in asset use, whether we need to be more efficient in financial leverage, means our financial strategies. So the dupe analysis can further be divided into the tax burden, net income, tax burden and interest burden, but that's not the ultimate part of it, because the tax burden can be different for different companies. Interest burden can be different for different companies. That's why we, instead of 3 steps, we divide into 5 steps. So where we say net income divide by earning before the taxes, our operational efficiency, sorry, the tax efficiency, and then the EBITDA about the earned before interest and depreciation, which the first is tax efficiency, second is the interest efficiency, the third is called operational efficiency, earning before interest and taxes, and then we call sales turnover ratio and sales efficiency and the financial leverage efficiency. So that's the 5 step deep analysis, which helps to kind of summarize all the different ratio, because all the ratios from here can be broken down. Sales divided by total assets can be divided into sales divided by inventory, sales divided by customers, AR, sales divided by assets, cash, right? So you can have multiple asset turnover ratios. So you can try to understand it for more details, but this will become the basis or the tree or the root of all the analysis. So that was all pretty much from us on the operational on the financial analysis tools to understand the operational efficiency. So let's look at few questions just to check your understanding. So the question number one is, a ratio has no meaning in themselves unless we compare them to a benchmark, uh, competitors, previous years, or all of the above. Well, you are right in a sense that benchmark is there, but you can compare the ratios against the competitors and previous years as well. So the right answer is all of the above, but we can accept your answer as a benchmark as well, because it shows me that you have understood it, because it can be the income. Now, the next question that we have is, to calculate the return on assets, the assets are divided by total, which is divided by total assets. Gross income, total income, income before interest, taxes, or net income. Correct. Net income. So that's the right answer. There you go. You're right. So the net income is divided by the total assets to get the sales turnover ratio. Accounts receivable turnover ratio is what? Credit sales divided by average amount due from customer. Credit sale divided by average amount due from our cash sale divided by amount due from customers. Both cash and credit, or cash sale divided by total amount due from our customers. So what's the right answer here? So accounts receivable turnover is calculated by credit sale divided by average amount due from customers. Yeah, so the first and the last choice was similar. So that's the correct answer. Credit sale divided by total amount due from the customers. Actually, is the total amount credit sale divided by average due from customers. So not the total amount. Total amount means that as of certain date, but because the credit sale is generated over a period of time, so the right answer is credit sale divided by average amount due from customer, and average is calculated by either the monthly average for the whole year, or you can take it for 1 month opening plus the closing amount divided by the two. So that's the right answer. And the last question that we have is, interest cover ratio means that what? Uh, how how easily a company can pay interest, or how easily company pay interest and principal, how early a company can pay all of its interest, or none of the above. Interest cover ratio actually will tell only the outstanding interest only. So means the correct answer will be the first one. How easily a company can pay interest on its outstanding debts. Interest only, because it's an interest coverage ratio, right? What the answer being chosen is that the how easily a company can pay interest and principal is not determined by the interest cover ratio. It's actually different. So it's only the interest. So the first A is the right answer. Okay, excellent. So that was pretty much it. If you have any questions now, I think the floor is open for any question and answers. So you can put your question in Q&A session, and we will be happy to answer that.